Hello, everybody. This is Alan Ellman, the blue collar investor, welcoming you to this BCI podcast number 97, titled Managing a Poor Man's Covered Call Trade When Share Price Drops Below the Leap's Strike Price. We're going to be using a real life example with PPL Corp, which trades on the New York Stock Exchange under the ticker symbol PPL. Let's start off by defining what is a poor man's covered call trade. Well, this is a covered call writing like trade that involves, instead of buying a stock first, but rather buying a long term, deep in the money leaps option in lieu of a stock. So the cost of entering the trade will be much lower. Now, once we have the rights to purchase those shares at the leap strike price, we then sell a short term, out of the money covered call option against that leap's position. This is technically known as a long call diagonal debit spread. And we enter these trades with shares that we expect to hold on to for a long period of time because a leaps option have expiration dates between 9 and 24 months out. So generally speaking, we're going to be using relatively blue chip companies as our underlying security since we do have long-term intentions. Now, the benefit of the poor man's covered call strategy is that there's less cash required to enter the covered call trade because the options cost much less than the shares themselves. However, like every strategy, there are pros and cons to the poor man's covered call. So that's something that we all must understand and master before making a decision as to whether or not this is the correct strategy for us and our families. That information is found in my books and DVD programs related to the poor man's covered call and beyond the scope of this particular podcast. So let's move on now to our real life example with PPL. On February 20th, 2020, PPL was trading at 35.42. So step one is to purchase the leaps option. Now that means we want an option that's expiring between 1 and 2 years out at a strike price much lower than current market value. In this case, we selected the $30 leaps option, which expired 1 year out on January 15th, 2021. The ask price or the cost of that leaps option was $5.70 per share or $570 for the contract. Now, 100 shares of the stock itself would have cost $3,542. So you can see the significance of using leaps option as our long position as opposed to the stock itself. Now, once the leaps option was purchased and we knew our cost basis, we're then free to sell the covered call. Once again, we're going to go out of the money short term. In this case, we're going to sell the 1 month out expiration of 3/20/2020 36 call, which of course is above the 35.42 current market value. The bid price on that particular option was 30 cents. Now, what happened in March of 2020 is historic. We had the crash of the stock market due to the coronavirus pandemic. Now, of course, the market did recover after that, but the following month, in March, the market did crash. So let's start out by putting in the data into the BCI poor man's covered call calculator to have a look at the initial trade structuring for this particular poor man's covered call trade. So into the blue cells, for those watching this podcast, you could see the screenshot of the spreadsheet. For those just listening, I will describe it in detail. We enter the price of the stock at 35.42. We enter the strike of the leaps option of 30 and the cost of the leaps option at $5.70. Now, The initial short call strike 1 month out was the 36 strike, which generated 30 cents. Now, once those cells are populated, then the calculations are done automatically for us with this PMCC calculator. And we can see that the initial return on the short call option using the cost of the leaps option as our cost basis actually is 5.26%, um, which is pretty significant. And that's the benefit of the PMCC strategy is that we have a lower cost basis and therefore the return on our capital is going to be much higher than had we purchased the shares. Once again, keep in mind there are negatives to this strategy. Now, the upside potential should PPL move from current market value of 35.42 up to the 36 strike would generate an additional 10.18%. So there's a possibility of a 1 month return of 15.44%. Pretty impressive. So that's how the initial trade was structured, but bad news was about to happen to everybody in the market in March of 2020. Now, if we looked at a price chart of PPL during that coronavirus crisis in March of 2020, we would see that once the trade was entered at 35.42, PPL dropped way down to 19 and then recovered to 26.70. So it was below the $30 leaps option strike price, which is pretty rare for the poor man's covered call since we're usually going deep in the money. But, this was an aberration in the market and something that we always have to be prepared for. So, what do we do? Well, here are our exit strategy considerations. First, we have to decide if our bullish assessment on the underlying security, PPL in this case, is still in place. Well, having a look at what happened here, we would realize it doesn't take a rocket scientist to realize that this wasn't an issue with the company, but rather with the overall market. So there's a good chance that our bullish assumption is still in place. We could always check the news to make sure there wasn't an additional company related issue, but there wasn't. In this case, it was just the entire market pulling down share price. So, what do we do in a case like that? Well, what we can do is we roll down using our 20%, 10% guidelines, like we would do in a traditional covered call trade, buy back the short call, and roll down to an out of the money strike. So, a lower strike than we originally sold, but out of the money based on the current market value of PPL at that point in time. Now, this will allow us to generate additional time value premium while at the same time still allowing for some price recovery as the market itself recovers. So during the month of February 20th and March 20th, there were multiple opportunities to roll down, roll down again, roll down again, constantly generating time value premium while still allowing share price recovery. That would be the way to handle a situation if we're still bullish on the security. Now, for some reason we weren't, well, what we have to do then is just close our position, bite the bullet, and take a loss, use the cash that's now made available to then enter a different covered call trade with a different security. But in this case, it was obvious that this was market related. So, step one when entering a poor man's covered call trade, to summarize, is to make sure that it fits our initial formula, which is the difference between the strikes plus the initial short call premium has to be greater than the cost of the leaps. In this case, looking at the PMCC calculator, you would see that that was the case. So that's step number one. Now, once we enter that trade and we move directly into position management mode, it's the short leg of the trade that is the active leg in our management, and we handle that pretty much the same way we handle traditional covered call writing trades. So we have to make a distinction when there is a gap down in price between a market issue and a corporate issue. Once we do that, we come to the conclusion whether or not our bullish assumption on that underlying security has changed. If it has changed, well, we close it, bite the bullet, take our loss, and move on. If it hasn't changed, roll down to out of the money strikes, generate time value premium, and still allow for share recovery. So again, if the leaps position is in place, the active leg is managed just the way we would manage any other covered call writing trade, including using and putting in place our 20%, 10% guidelines. Very, very critical to successful management of our covered call writing trades. As I always do with these podcasts, I want to point out to you our BCI package, which is our best and most comprehensive investment package ever offered by the blue collar investor. It includes 6 online video courses with downloadable workbooks, 6 calculators found only on the blue collar investor site because we created them, we developed them, it's ours, and 5 of our best selling books, which are in ebook format. In addition to that, you have an annualized premium membership, which includes a huge educational component of 200 videos, as well as our reports. And that's a 13-month membership that's included in the package. You can find the link to the BCI package on our website, www.thebluecollarinvestor.com. Just look for the link that says BCI package. Those of you watching this podcast, you could see it circled on your screenshot, but it's found on every page of our website. There's a video there that will also describe in more detail all the information you need to make a decision as to whether or not this is the right product to you and your family. So, ladies and gentlemen, I want to thank you very much for taking the time to listen to this BCI podcast, number 97, Managing a Poor Man's Covered Call Trade When Share Price Drops Below the Leap's Strike Price. We have to be prepared for every and any situation that might occur once we enter these trades. Folks, I hope you found this video enjoyable. And more importantly, I hope it ends up putting cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.